Hey guys, welcome back to another video. So the popular fund manager CATHIE Wood, who owns and runs ARK Innovation, the ETF, and various other ETFs, she gave her monthly remarks on the state of the economy, and when she speaks, people listen. So I wanted to break down some of the key points she mentions because she seems to believe that the economy is starting to fundamentally weaken. So she believes this is not just a supply chain issue or a temporary glitch, but we could be seeing a fundamental weakening in the underlying economy. So let's recap what she kind of went over. So the first thing she touched upon was obviously her monetary and fiscal policy update. So she rightfully noted that M2 money supply is coming down. So you can see we peaked at 27 mark here, and you can see now we're at the 12 mark. Now, that's coming down despite the government still purchasing. Tapering hasn't begun. We're still purchasing 120 billion of assets each month, but this is starting to fall. And the reason this is starting to fall is because the stimulus is starting to wane. And naturally, the money to the M2 supply will therefore fall as less and less stimulus checks and other stimuli are being pumped into the economy. So to speak, the Red Bull is coming out of the system bit by bit. And so when you come off the painkillers, the real effect can really start to take impact. Now, we heard signs, and we've covered this extensively on this channel, that QE could well be not coming forth in the next meeting. So we saw that we had weak non-farm payrolls, which we'll touch upon shortly because CATHIE mentions it as well. And that could mean that tapering could be delayed, maybe even into next year now, given the weakening we're seeing in some readings. Now, she also touched upon the fiscal policy. So we know that there's 3.5 billion of fiscal stimulus, which has been put forward to the House. That has been delayed by a few senators who are claiming that this may not be the best idea given the debt to GDP ratio in the United States. So you can see debt to GDP is on the rise, currently sitting 107.6, and really you want to be keeping that at 75 to 85% for sustainability. So that's already tanking out of control, and it's got some senators believing that maybe the 3.5 trillion package isn't necessary, but the core 500 billion to 1 trillion package could perhaps pass. Okay. Now, the other concern is fiscal policy could indeed aggravate the inflation concerns we're seeing, and CATHIE Wood rightly points that out, that perhaps that could be an issue. Now, she then moves on to the economy and employment, and she obviously covers off the non-farm payrolls, which we received the other day, and we covered that on this channel. The consensus was 735, and we saw a disaster reading at 235,000 new jobs. She then starts to explore whether this is indeed Delta-induced, and similar to the conclusion we came up with, it does seem to be Delta-induced. We saw, for example, that leisure and hospitality didn't contribute any new jobs in the period, despite growing very strongly in the months leading up to it. So that's an indicator and corroborates the idea that Delta is having an impact on the employment market. Now, she also tries to explore the idea of whether it could be supply chain issues. And the way she tries to corroborate this very smartly so is she looks at the manufacturing average hours worked in manufacturing, and she saw that ticked down by 0.5%. Now, it sounds minuscule, but 0.5% less hours worked annually is 6 hours less, 6% less hours worked. And that potentially could indeed be to chip shortages and the supply chain issues we've been talking about now having an effect, and meaning that employers are having to ask their employees to work less simply because there's no manufacturing to do without any chips. Which is very interesting. Now, construction employment was also down, which could also be supply chain related. Then she goes to explore this idea of, is the economy fundamentally weak? And so the way she does this is she starts off listing a few positive indicators. And so let's go through some of the positive indicators she was mentioning. So the first one she wanted to mention was, so we covered the non-farm payrolls. The first one she wanted to mention is there are now currently over 10 million new jobs available, jobs on the market. Now, we covered this before on the video as well. Now, it's interesting to see that non-farm payrolls are missing consensus, but there is still this kind of excess demand for workers. Now, clearly we can see there are two things going on here. One, and CATHIE corroborates this as well. One, we're seeing the fact that workers are not being paid enough. So CATHIE mentions how Walmart have increased their minimum wage now for employees to try get people to come in. But the other thing we mentioned on this channel, and CATHIE also mentioned, interestingly so, was there seems to be a skills gap, right? Workers are demanding a certain type of work and employers want a different type of work. So one, there's a kind of a stylistic difference in the type of work people are wanting now post pandemic, but also there are skill gaps where employers, as CATHIE said, are going to have to start training people to cover the type of jobs needed. So we're in a bit of a weird situation where non-farm payrolls are not moving at the pace we want them to, but at the same time there's so many jobs outstanding, and that's very interesting. So that's a strong indicator that there are lots of jobs available. Employers are looking to higher. Now, she also mentioned that the claims reduced, which is very interesting. So if I just share this, you can see that unemployment claims fell to a pandemic era low with 340,000 filings for aid. Now, to put this into perspective, this was 6.1 million at the peak of the pandemic, and the pre-COVID kind of normal level is 250 claims, which is very interesting. So we're making substantial progress towards that, and that's a good sign for the economy, which CATHIE Wood also mentions. Now, we can also see that personal incomes rose by 1.1%, and we saw that savings went up, are now up to 13%. Now, 13% is being saved, and normally this is 7 to 8% pre-pandemic. So there's definitely cash piling up, and people are sitting on cash. But this, we'll come on to some of the weak elements shortly. These are just the positive elements around the economy. Now, she then mentions that we've had good numbers in terms of new and existing home sales. We've seen those trending up. And we saw the PMI reading head to 66.7. So another strong purchasing managers index reading, PMI reading, which suggests that companies are trying to keep up with the demand for products. And this is where we're almost coming back to this supply chain issue. So those are the positive remarks. And then after that, CATHIE then juxtaposed her kind of negative indicators around the economy. And she starts off with the Michigan Index for Consumer Sentiment. So this is the idea that how are consumers feeling about the economy. And you can see here now, we've fallen to about this 70 mark, which takes you to pre-2011 levels, which is the point that CATHIE makes, which was when we had the sovereign debt crisis. So for those of you who remember, you had the financial crisis, you had the subprime mortgage, and then you went into the sovereign debt crisis with Greece and Contagion and all the rest of the things. And we're almost hitting those kind of a level now. You can see charts here. It doesn't go that far back to 2011 levels to give you an idea of where we're heading to. So she's mentioned that's a bit of a concern in terms of consumer sentiment as being a weak indicator. She also mentions that retail sales dropped by 1.1%. And she makes a clever point here, which is retail sales dropped by 1.1%. But remember, at the time, CPI was 0.5%. So really, it's 1.6% real drop in retail sales. That's a very good point there. And that is an alarming figure for retail sales. And she kind of gives some anecdotal reasoning for this. And what she says is consumers are starting to expect inflation. And when consumers expect inflation, that can have a self-fulfilling prophecy. And we can see here from the Michigan consumer sentiment, which is really tanking down, that this is starting to become a trend among consumers who are perhaps starting to expect inflation, which is quite worrying. Now, she rationalizes that one of the reasons this could be is because we are seeing real average hourly earnings are down by 1.2% year on year. So if you're to strip out the inflation element, average hourly earnings are still down 1.2%. So people are feeling 1.2% poorer, and that's having an impact when they're going to fuel up, when they're going to make any purchases. They're feeling that. She spends quite a bit of time talking about auto sales. So she mentioned that auto sales peaked to 18.5 in February, and now August is sitting at 13 million units. That's a 30% decline. But then she spends some time to say, if this is based on actual chip shortages, because a lot of the auto manufacturers are claiming this is based on chip shortages, but is this actually the case, or is there another underlying cause? And what she reasons is, she says maybe consumers have already purchased and all this inventory is sitting on the driveways and the garages of consumers. And she hypothesizes whether consumers are actually waiting to rotate into EV purchases versus the ICE internal combustion engine purchases, because as the cost of ownership for EVs are coming down, are people, this is what she's rationalizing, are people starting to rotate across to EV purchasing? And she gives some stats around this. She says she believes EVs, through her research and her team's research, will go from 2.2 million units sold in 2020 to 40 million by 2025, and her estimate for 2021 sits at 3.8 million. So you can see you've gone from 2.2 to 3.8 on EVs, but the total auto market has reduced from 18.5 to the 13 million mark. So she's saying there's a clear, if the whole market's reducing but EVs are growing at 50%, there seems to be a rotation across to electrical vehicles, which is an interesting point. She then spends some time talking about the Mannheim Car Index, and we've heard her speak about this before. If I just show you the index, she mentions that it peaked, rightly so, in May at 200, and now it's sitting at 193. And she says if there is indeed a chip shortage, what she would expect to see is this should go up. The Mannheim Index should go up if indeed there is a chip shortage, but if it comes down, then perhaps this is more of a rotation from internal combustion engines to electrical vehicles more long term. So she's waiting to see how this kind of trends over the next few readings. This reading comes by every 2 weeks, bi-weekly. Now, she speaks a little bit about excess inventories, which is an interesting point, because she says, and she uses an example of chlorate. She's saying a lot of consumers, and we've thought about this notion before, during the pandemic, stocked up a lot on durable goods, right? So those goods which last and don't expire, people have stocked up on those. And she's feeling as though, and she's looked at the reading, she can see that business inventories are going up. Companies aren't turning their inventory over quick enough, and she's rationalizing that that's because the consumers have already stocked up. They've already got plenty of Clorox at home, and they don't need to buy any more. And that could be leading to the issue we're seeing there. Interesting point. Now, she also discusses the lumber prices, which I want to show you here. So we saw the lumber prices were just ridiculous. It peaked at, I think, 1711, and now it's back to the 500 range, as you would expect, sitting at 555. So we saw that was a temporary glitch in lumber, which has now seemed to fix itself. I'm almost trying to wonder, and then she then tries to rationalize whether it's the same for chips. And she talks extensively about the RTX 3070 chip, and she spoke about how it was sitting at $1,421. It then went to $1,060. Is it a temporary glitch? Will it start to trend back down? This is all speculation, and we won't know until we know. So that's her idea. That's her rationale behind, look, the weak indicators of the economy are outweighing the positive indicators we're seeing. So from a positive perspective, she's saying, look, we've got a number of jobs available. We've got the unemployment claims are starting to come down. Personal income is rising. There's good new and existing home sales, and the PMI is looking good. But from the weak perspective, you've got consumer sentiment down, retail sales are dropping, real average hourly earnings are going down, auto sales have seemed to peak and are falling down. Electrical vehicles are still trending up within that space, but overall unsure. You can see business inventories going up. So she's quite concerned about that. And then she spends some time talking about equities, and she recaps the year. So we know how the year started off with growth coming in fast. We then saw Feb to mid-May with people rotating across to cyclical value stocks. And now she says people are now starting to diversify and go into more defensive names, which include real estate. Your FANG stocks, Facebook, Apple, Amazon, Netflix, Google are typically now your FANG stocks. People reverse to them when they're unsure about the economy. And she feels like the next rotation across will naturally be growth and innovation. And naturally, obviously, CATHIE's interest lies in this space. She will always be pushing the growth and innovation space, but she makes some clever points. She says, look, when an economy has problems and challenges, innovation comes in to solve those problems and challenges. And she lists a few. She says, look, we're facing inflation, and she feels EV pushing prices down will solve that issue. She says the other issue with inflation can be inflation being an issue can also be addressed by crypto, because people are flocking to crypto as a hedge. She speaks about DeFi solving the challenge of people searching for yield. You've got investors searching for 4, 5, 6% yield, and it's not obtainable in the traditional fixed income markets at this point. And perhaps that's why people are taking more risk into DeFi. And then she spent some time talking about healthcare and DNA sequencing, really reducing costs, and artificial intelligence training costs coming down. So overall, a really good set of remarks by CATHIE. I felt as though she broke that down really well. I mean, look, whether this is a truly weakening of the economy underlying is yet to be seen. I think we're going to need a few more readings to find out. We've got the CPI reading on the 14th, I believe, of September, and then you've got the Fed convening on the 22nd. Like I said in my previous video, I don't think we're going to see a taper given the situation. I think at the very earliest now, you're going to see a November-December taper, but almost likely going into next year for a taper at this point, given the data we have on hand. But overall, it's been a bit of a tricky time because you've got a bunch of indicators suggesting good things in the economy. You've got a bunch of indicators suggesting a bit of a downtick in the economy. And we're just going to have to see how this plays out over the next few weeks as and when we get more data. So there you go, guys, an update on Cathie Wood's remarks. If you enjoyed this video, please don't forget to like, comment, and subscribe. And I will see you in the next one.